you could do about this to come out ahead. There is one more shift that could even have a bigger impact than China, and that would be global diversification. Like, here's the reality. Even though Goldman Sachs projects that China overtakes the United States as the world's largest economy by 2035, the real story is the fact that India's population is about to hit 1.5 billion people. It's younger than China's, growing faster, and incredibly tech literate. That's why their forecast is that India becomes the world's third $10 trillion economy by 2036, and eventually they'll get so massive that they rival both the United States and China. On top of that, once you zoom out even further, by 2050, emerging markets are expected to make up nearly half of the global stock market, up from just 27% today, with India alone potentially tripling its share. So in terms of what this means for you, here's where things get interesting. As of right now, the average American investor has about 80% of their money in US markets, like the S&P 500, which made perfect sense for the last 50 plus years when the United States was the fastest growing, most profitable economy on Earth. However, over the last year, every single major institution has updated their 10-year return forecast of the markets. And for the United States, the general consensus was not so great. Like, when it comes to this, Vanguard is projecting US stocks to return just 3.9 to 5.9% annually over the next decade, while international markets are expected to do even better at 4.9 to 6.9%. And it doesn't stop there. JP Morgan is even more bullish on emerging markets, projecting around 7% annualized growth, with Fidelity estimating over 8% annually over the next 20 years. Or I guess put more simply, the general consensus here is that international markets are going to be outperforming the United States over the next few decades, purely because they have more room to grow and they're starting from a lower baseline. In addition to that, it's also believed that US valuations are already very stretched. The top 10 companies now make up about 40% of the entire S&P 500, which is a concentration risk that very few people talk about. And a weakening dollar on top of this means that foreign stocks, even if they earn the same amount in local currency, will actually return more to US investors once you convert those back into dollars, if that makes sense. Like, just think about it. The national debt continues to skyrocket. We're constantly printing more money to pay for things we can't afford. And over time, this is undoubtedly going to weaken the underlying currency that we all use and transact in. So in terms of what you could do about this, here's my honest opinion when it comes to the dying dollar. As it stands today, even though the US dollar does appear to be in trouble long term, the good news for all of us is that as of right now, there's no good alternative to take its place. For example, Europe has debt crises and political fragmentation. China has strict capital controls, limiting the amount of money you can move in and out, making it an uncomfortable reserve currency. Gold? Well, you just can't send it across borders in real time to settle debts. And even Bitcoin is proven to be too volatile to act as a reliable store of value in the short term. That's why the US dollar, with all of its problems, has something that no other country has, which is a massive, liquid, globally trusted market with a very well-capitalized military. Like, when a crisis hits, money still flows into the United States instead of out from it, and the data backs this up. The dollar is currently used throughout 89% of all foreign exchange transactions. SWIFT data from February shows the dollar at 49% of all global payments, and even the BRICS alternative payment systems still largely route through the dollar infrastructure. In fact, China's own payments still rely on SWIFT messaging for a significant portion of their transactions. Not to mention, the United States is still the world leader when it comes to artificial intelligence, semiconductors, and biotech. This means that short term, we're not seeing a dollar collapse. We're just seeing a dollar dilution, where the United States is becoming a global superpower instead of being the only global superpower. And that transition is likely going to take decades to play out, not years, which is why the early money is starting to get ahead of it today. So in terms of what comes next and how you could best invest moving forward, here's what you came for. First, don't go all in on the United States. I've been saying this now for years, but it's still very true. Just like you shouldn't put all of your eggs in one basket, neither should you put all of your money and resources into one country. Like, just ask yourself the question, are you willing to bet that the United States stays on top forever? And are you being paid enough for the risk that maybe they don't? For this reason, I just think it's worth it to invest a portion of your money throughout other countries, just in case. Which leads me to number 2, emerging markets. Honestly, when JP Morgan, Schwab, Vanguard, and Fidelity all come to the exact same conclusion independently that international and emerging market stocks look more attractive than US stocks on a valuation basis, I just think that's worth paying attention to. A simple international index fund is really just all it takes, and even if they're all wrong, never hurts to have a little more diversification. Third, we have precious metals. I know I've never been much of a buy gold person, but when central banks are buying it at the fastest pace in more than 50 years, and their argument for it is simply the government can't print more of it, I think it's worth taking into consideration as a small part of your portfolio, again, as a hedge and a little more diversification, especially with debt cycle dynamics that we've all been talking about. From there, though, number 4, it's also worth it to own some commodities. This includes items that the world needs to run on. I'm talking oil, metals, copper, food, you name it. The theory here is that as emerging markets grow and the dollar begins losing its grip, historically, commodity prices rise. So this should provide a little insulation if we see supply shocks or higher inflation, especially as Goldman Sachs keeps highlighting that commodities are one of the best insurance policies in a changing world order. And finally, fifth, don't abandon the US entirely. Even with lower returns expected, Vanguard still projects a 4 to 6% annualized return. The US still remains the world's largest economy. We have the best innovations and tech ecosystems, and we have the deepest capital markets. So yes, being heavily invested in the United States still makes sense. It's just not worth it going all in and expecting the same returns that we've seen over the last 20 years.